Hello, we are Group 6 from Tutorial 10 and we will be presenting the project evaluation for Cobalt Blue. Our main project will be the Broken Hill Cobalt project. It is an integrated mine refinery initiative aiming to maximize cobalt margins in a fluctuating global market. Depending on demand, the project can adjust its production to deliver either mixed hydroxide product or cobalt sulfate. Our alternative project will be in the Republic of Congo Central African Copper Belt. Known for its rich cobalt deposits and established mining infrastructure, this project proposes a similar scale venture like the Broken Hill project. Despite different geological and operational conditions, this project is assumed to match the production capacity of the Mutunda mine.
The financial status of a company is crucial as it provides insights into the company's overall stability and performance. Financial indicators enable investors, creditors, and management to make informed decisions regarding investment, lending, and strategic planning. With the information sourced from the Cobalt Blue Annual Report 2022-2023, we were able to determine the following financial indicators. Overall, Cobalt Blue Holdings demonstrates a mixed financial status. Their debt ratio signals stability but raises concerns about tax benefits and returns on equity. Their current ratio shows strong liquidity but hints at asset underutilization impacting efficiency. Their low asset turnover ratio indicates revenue generation inefficiencies. Despite a standard return on equity, there's room for improvement to meet market expectations. And finally, their price-to-earnings ratio attracts value-oriented investors but suggests slower growth.
This is the cash flow for the Broken Hill project. There are five variables that are not affected by inflation. Those are depreciation, debt interest, capital investment, borrowed funds, and repayment of the principal. In the income statement, we can see that the net income starts to increase in positive values from year 1 to year 17. For the cash flow statement, the net cash flow is negative 360 million in year 0. However, starting in year 1, the net cash flow for this project keep increasing with positive values until year 17, which is the end of the project life cycle.
The Cobalt Copper Mining Project's financial overview shows revenue growth starting at 839.75 million in the first year and increasing to 1.53 billion by the final year. Manufacturing, operation and maintenance costs also rise from 88.12 million to 155.17 million over the same period. Depreciation remains constant at 29.02 million annually. Debt interest decreases steadily, reaching zero by 2039, which is the final year, elevating financial strain. Income tax escalate from 300.83 million in the first year to 539.13 million by the final year due to inflation, with a net present value and PV of 6.48 billion at a 5% discount rate and 5.2 billion in a constant dollars. The project demonstrates significant value creation beyond the cost of capital. These figures, along with positive operational cash flow and an efficient debt repayment schedule, underscore the project's strong financial health.
The payback period indicator is a figure that determines the amount of project life it takes from the initial investment for the project to pay itself off. From the Broken Hill Cobalt project, we calculated a payback period of 2.31 years, and for the Kapoi Copper Mining project, we had 6.13 years. Considering both projects have a life of 17 years, both pay themselves off relatively early, which is promising for investors, but Alternative A is much faster than Alternative B. The net present value indicator can be used to discover the present value of a project, which alongside the net future value indicator can help investors pick alternatives if the project possesses similar discount rates and project lives. The Broken Hill project had an NPV of around $1.76 billion, and the Kapoi project had an NPV of around $4.16 billion. Though the Kapoi project was much larger than the Broken Hill project, it is important to keep in mind that the initial investment was also much higher. The benefit to cost ratio indicator is used to outline the ratio between a project's benefits to its costs. If the ratio is greater than 1, the benefits of the project outweigh the costs, but if it's less than 1, the costs outweigh the benefits. The Broken Hill project had a ratio of 10.77 and the Kapoi project had a ratio of 4.12. Both projects have benefits that greatly outweigh the costs, but Alternative A is far superior to Alternative B.
And finally, the life cycle cost, otherwise known as LCC, was calculated at $1,407,540,954 for Alternative A and $2,747,139,087 for Alternative B. These calculations encompass the initial investment annual operating and maintenance costs, and the salvage value at the end of the project life. The LCC is crucial for evaluating the financial viability of project alternatives as it includes all costs over the project's lifespan, providing a comprehensive view of the total financial commitment required. Overall, Alternative A offers quicker returns and lower costs, making it a less risky and more efficient investment. While Alternative A's NPV is lower than Alternative B's, it is still significant and reflects substantial returns. Furthermore, the benefit-to-cost ratio highlights its efficiency and profitability, making Alternative A a superior option in comparison with Alternative B. While Alternative B promises greater long-term value with a higher NPV, its higher initial costs and longer payback period make it considerably less attractive. Despite the potential for higher returns, the larger initial investment and increased financial risk make Alternative B a more complex choice for investors. The comprehensive analysis of LCC, NPV, payback period, and benefit-to-cost ratio for both alternatives highlight the importance of weighing short-term versus long-term benefits to select the most financially viable project.
Qualitative risk assessment identifies risks and their nature by outlining the likelihood and impact scores of the events in a risk severity matrix. This is to prioritize and develop mitigation strategies for them. This event significantly impact the sustainability and financial aspect of the project. Geotechnical challenges can cause inefficiency, high extraction costs, reduced output, and potentially halting the operation. Environmental challenges can result in regulatory penalties, lawsuit, loss of social license to operate, community opposition, and operational disruption. Technical and operational challenges can lead to lower productivity and high operational costs. Poor infrastructure can also reduce access to basic necessity and disrupt the workflow. Finally, socio-economical challenges can affect revenues, costs, regulatory compliances, protests, production disruption, legal action, reputational damage, and financial instability. The quantity assessment involves sensitivity analysis techniques by changing key variables that affect the financial performance. The analysis evaluates how the NPV responds to variation in price, demand, growth rate, variable costs, fixed costs, and discount rates. These variations are ranged from -20% to 20% with 5% increments. For example, the unit price is changed to -20% of its original value and then the NPV is calculated and recorded. This is repeated for all the variables and for alternative B. This table shows the result of every NPV values for each variable changes. From this, the graph will develop for further analysis. As you can see, they are relatively similar. The lines represent the NPV value per percentage change. The steeper the line, the more sensitive a variable is to fluctuation. From this graph, we can conclude that alternative B is more viable and less risky as it produces less deviation for any variation.
So, for our weakness and suggestions, the analysis is based on assumptions about market conditions and recovery rates and technology. Alternative B is still planning, so its values are based on similar projects and general information. On to our second point. The sensitive analysis is too narrow, focusing mainly on price and cost variables, including market dynamics, technical advancements, and geopolitical challenges would provide a broader understanding. Number 3. Further analysis should include conducting detailed feasibility studies for both projects, encompassing geological surveys, market analysis, and cost assessments. Finally, establishing a framework for continuously monitoring and periodic reviews of project progresses. To conclude, the Broken Hill Cobalt project stands out as the preferable initial investment due to its financial robustness and lower risk. However, the Kilpoy copper mining project holds promise for future expansions. Both projects contribute strategically to the cobalt supply chain, aligning with global trends towards sustainable energy and technological innovation.
This is our references and thank you for listening.